Take advantage of this presentation that I put together for you. It's going to provide you with the data, the information, the discussion topics that's going to help you make a decision whether it makes sense to purchase a home, sell a home in 2024, but also maybe you're a real estate agent, maybe you're a loan officer. It's going to help you become an advisor as a good certified mortgage advisor, as a good mortgage loan officer. I'm providing you this information. This is my gift to you all for 2024. My name is Darin Hunter. If you learn anything, please do me a favor, like, subscribe, follow along, and let's go ahead and get right into it. The underlying theme of this entire presentation is going to be supply and demand. We've heard about supply and demand for literally years now, ad nauseum, but we're going to look at it from an interest rate perspective and as well as a real estate perspective. And, as housing is determined by supply and demand, we're going to talk first of all about inflation, as inflation is a big driver as to where mortgage interest rates go. And, first of all, we're going to look at core CPI, which is the consumer price index, and the core PCE, which is the personal expenditures. The Fed looks at this, most importantly at the PCE, and the Fed really wants a 2% target. But this past month, we're not at a 2%, and actually you can see year over year here, our core PCE is at 3.2 and our core CPI is at 4%. But this past December, the Fed actually pivoted. Without cutting interest rates, their discussion was that they're going to pivot. And, and this is before we've actually gotten to that 2% target. So they're not actually going to wait until that. They're going to cut before that 2% target. And typically what they do is they cut in about quarter point at a time. Powell didn't give an exact amount he's going to cut by, but we can handicap that. We can look at it directly and figure out what's actually driving inflation, and typically, and what's been the biggest driver of inflation over the last couple of years has been shelter costs and rents equivalent. So shelter costs have been the primary driver of inflation and what's kind of keeping it sticky. And as this blue line reads or shows, you can see where, back in 2021, we had this parabolic move where shelter costs just absolutely spiked up to about 14% year over year. And now they've come down to about 2.5%, and that's where we are currently. So they're still rising at a 2.5% clip, but obviously significantly less than what we were experiencing. And that's real time. And this is a blended rate, and how we come up with this particular 2.5% is, this is new rental leases or anything that you take out. If you sign a new lease, you're actually seeing a little bit of a decrease, but if you're renewing a lease, you're seeing a 4.5% increase. And the theory behind that is, if you're in obviously rentals are tough to come by. So very similar to buying a house, if your landlord believes you're stuck in that property, they're going to increase your rent, and you're going to pay a little bit more to stay because it's going to be a little bit more challenging to get up and move. And the fact of just moving and packing up your stuff is challenging as it is. So landlords do believe that they have you stuck, and that's why you're seeing about a 4.5% increase. And when you take the two and you blend them together, we're seeing a 2.5% increase. So again, we are seeing an increase in rent and shelter costs by about 2.5%, but significantly less than what we've seen in the past. Now, the problem with what's happening right now is the Fed is not looking at what is currently taking place. They look at a 12-month average. On top of it, if the lease is signed in advance of the lag, it could actually be even worse. So the Fed is actually looking at this gold line, and you can see right here that the peak of the gold line is actually later than the peak of the blue line. And, again, the blue line is real time. The gold line is a 12-month average. So the Fed is looking higher, but in reality, the actual increase in shelter costs is actually lower than what they're actually calculating. Now, eventually, they'll get to a similar location, but there is absolutely a lag effect. The weighting in inflation report is significant as well. So this is a major factor, major data set when they're calculating our inflation numbers. In fact, the shelter is 44% of the core CPI and 21% of PCE. So there's an enormous overstatement in what is actually what the shelter cost actually is right now versus what they're reporting in the calculation of PCE and CPI. So when you take into account the difference, I mean, there's 4%. And 4% between what's currently taking place real time and what they're reporting in there. And weighting this, you'll see there's a huge lag effect. So let's go to the next slide. All right, up here we're adjusting and we're calculating what the lag effect is. When you look at the lag and adjust for it, you'll see that the numbers are actually closer to 2% target on both the CPI and the PCE. In fact, when you look at the last 6 months, the run rate, and this is something actually we know the Fed looks at, it's actually below 2%. It's 1.85%. So these numbers, this lag, when you take into consideration the lag effect, these numbers are closer to the 2% target that the Fed has on PCE and CPI, which is going to force their hand, and they already have in December. They've already mentioned it. They're going to be looking at having to cut interest rates, and that's exactly what's taking place right now. Looking forward in the upcoming CPI and PCE numbers, and knowing that shelter has such a bearing or such a weight in these calculated numbers, we can come up with we're going to get a new number actually on January 11th for the December numbers. So the way it's calculated is essentially the number that comes out in January is for December 23. It's going to replace the December 22nd number, which was 0.79%. And so again, remember, we've seen that the numbers have been coming down. And, we're likely going to get a lower number that has been averaging around, if you look here, since basically April, you can see from April all the way through October, November of 2022, of October 2023, you'll see that we're averaging about 0.4. So the number that we're replacing of 0.79 in December of 2022, we should see a pretty strong benefit in the CPI number that comes out on January 11th. Now, this should continue in February and March as we get the January 2023 and the February 2023 numbers to replace the 2022 numbers. You can see here the 0.74 in January of 2022, 0.76 in February of 2022 should be replaced by a much lower number for 2023, which is going to 2023 and 2024, which is going to provide us a significant benefit as we're calculating CPI. And again, interest rates tend to follow inflation. So as inflation CPI gets closer to that target, that's going to help us see interest rates come down and the average continue to come down on our CPI. And so the first quarter should be fairly significant for us on the interest rate side. All right, so after the first quarter, it's going to be more challenging. There's no doubt about it to make any progress as numbers that are beginning to be replaced. We're much lower in 2023. So first quarter numbers should be digested positively as far as rates are concerned. So what does the Fed look at? The Fed looks at the current core PCE, which is currently at 3.6%. How does the math work? On January 26, we get the core PCE numbers for December 2023. 0.1% is the estimate, and the same for January and February, as you can see right here. We should make good headway on those shelter costs. Relatively low numbers for the first quarter, and like we just went over for CPI, but the following months throughout the year, it's going to be a little bit more challenging. And so the biggest benefit to interest rates on the inflation front is going to come from the first quarter of 2024. Similar to the CPI calculation, when the new number comes out for December 2023, which comes out in January, it replaces the 2022 number. Now, you can see that December 23 estimate was 0.1%, and it's replacing 0.39% of 2022, December 2022. So it's going to equal 0.29%. We're going to take that 0.29% from the current PCE of 3.16, and the number is 2.87. So that's what inflation is going to look like on the PCE front. It's below 3%, but it's not quite enough to the target of 2% for the Fed to actually make an interest rate cut in January at the next meeting. So as we get into the March 20th meeting, you'll see that the core PCE year over year, dips just below that 2.5% number. Now, it's not at the 2%, but I believe that's going to be the trigger. It's going to allow the Fed to make their first cut in March of 2024. That'll be the first of a few that I anticipate for 2024. So that 2.5 number could be the trigger that allows them to make that cut. Now, as we look further into the year, as we get closer to May, you can see, and even into June, we actually get below that 2% target. So based on these estimations, we're actually going to be overshooting the estimate, which should again allow for more cuts coming in the near future. Now, of course, this is my opinion, but what about the markets? What are the markets saying? So out there, there's odd makers out there, just like if you go to DraftKings or you go to your bookie and you're gambling, and there are odds makers on what sort of cuts are going to take place. And you can see that there's in March, they're starting to tip the scale, 68% chance that they're going to cut interest rates in March. As we get into May, as I mentioned in the previous slide, we got very close and below that 2% target. You can see that those chances almost are 100% in May, and in June, and going forward, it's 100%. And actually, you can see where there's multiple cuts priced in, and the chances of a 56% chance of a 50 basis point cut as we get into May. So that would mean multiple cuts to May, and a 91% chance of a 50 basis point cut. So it's almost certain that we're going to see at least 2 cuts by the time we get to or into the June meeting. And then even a greater chance, now we're tipping the scales into the 50%, 53% chance that there's going to be a 75% cut into June. So again, you can see that this isn't just my opinion. The markets do believe that we're going to see lower rates, and we're going to see Fed funds rates being cut in 2024. Now, you've got my opinion. I just gave you an example of what the market thinks, but what about the minds of the Fed? So if you're not aware, the Fed actually puts out what's called a dot plot. And a dot plot is basically a unanimously plots where they believe the interest rates are going to be at the end of the year. So if you can see right here in 2024, 2 of the members believe that there should be 0 cuts in 2024. 1 believes there's a 25-point cut by the end of 2024. What is that? 5 believe that 50 basis point cut. 6 believe 75 basis. 4 100 basis points, and 1 at 150. So the bias is towards lower rates. 3, maybe 4 cuts in 2024. You can see that the majority believe rates will be lower in 2024. But look ahead at 2025 and 2026. There's a tailwind. Rates are dropping in by a fairly good amount over the next 3 years before they even start to level off. So think about what this does for purchases. Think about what this does for refinances over the next 3 years. This should provide additional support for values as more and more are in the market for a home, and gives the folks an opportunity to refinance. You should be looking at buying a home, as this is a golden opportunity. As rates improve, we should be seeing a boost in more appreciation. You can buy a home and you have a high probability of refinancing. Look, I'm rarely in the camp of buy now and refinance later, the whole date the rate, marry the house. That is not me whatsoever. However, the more and more I look at this data, the more and more we look at the opportunities that are out, there is a high likelihood that you'll have that exact strategy play out, where you buy a house and have an opportunity to refinance. And if the sooner you buy, the less expensive that home is going to be. I mentioned earlier that the underlying theme of this particular presentation was about supply and demand. And right here, when I'm looking at the Fed balance sheet, that's exactly what we're going to talk about right here. So back in the 2008 crisis, we saw where the Federal Reserve's balance sheet, started to increase fairly significantly for that particular time. Now, moving forward to the COVID crisis, there was a parabolic move in the balance sheet as we got all the way up to 8.5 trillion, on the balance sheet, which is absolutely unbelievable compared to where it was in 2009, 2010. But finally, we've reached a point where they've said it's enough. And so they started unloading about 1.4 trillion. Now, that's a big move, okay? I get it. It does seem like maybe it's a drop in the bucket, but that's a significant move. And what that's done is it's flooded the supply out there, and because they're unloading this, it had to be absorbed, and it came at a cost, and the cost was higher interest rates, and that's exactly what we saw in 2023, as especially our mortgage interest rates got all the way up to 8%. But recently, rates have gotten better because the expectation of lower rates has banks being super aggressive and locking in those higher interest rates on the debt that's being issued by the Fed right now. Why? Because again, the expectations is rates will go lower. What's going to be critical in 2024 is determining when the Fed is actually going to slow down and eventually stop the runoff of treasuries and mortgage-backed securities. So looking at the 5-year period between 2014 and 2018, it was about half from its peak. You can see the peak is at 8.5 trillion. GDP was 19 trillion, so the balance sheet was about 22.4% of GDP. Before COVID, the balance of the securities went up, but the percentage went down. So the Fed was actually good with that due to the fact that GDP was increasing. And again, the percentage of the balance sheet actually went down. But at the peak, at 8.5 trillion and GDP went up, the percentage of GDP was just too high. 33% of the balance sheet was too high, so they had to offload. So here is where we are now. We saw the graph showing the peak and the decline, and now you can actually see that numerically here. Now, additionally, our GDP has gone up, so our percentage has dropped to 25.6%. However, it's most likely outside of their comfort zone. It's probably their comfort zone is probably closer to 22, 23%. We already know what the runoff is going to be, and we can take a reasonable guess at what GDP is going to be. As we go through the numbers and we get to that March number, you can see we're going to be right around that 25% number. This is still probably too high for the Fed's liking. And however, it's not going to hinder them or shouldn't hinder them from actually cutting interest rates. However, the runoff will still take place. And so ultimately what that means is we're not going to see the full benefit of the decrease or the cut in the federal funds rate. As we get into the May meeting and we get under that 25%, June gets to 24, you can see that we get in the second half of the year, the percentage of GDP will get even closer to that comfort zone. It seems like a great spot for the Fed to pump the brakes. And don't forget, I don't know if you recall or you remember or you've thought about it, but there's an election that's taking place next year, or this year, I should say. And there's probably going to be some pressure out there for the Fed to actually pump the brakes and stop running off the balance sheet. So I would expect, the second half of the year, the Fed will actually slow that to a trickle, if not stop entirely at the second half of the year, due to the number one, getting to that percentage of GDP, but also getting that pressure during the election time. As they put themselves in a position to slow down or to stop the runoff, they've got to be careful. If they overshoot, there's going to be a high likelihood of recession. And you can see in this chart, rates do like a recession, and they decline during a recession. The Fed's balance sheet will be a critical component. The less supply should improve rates because buyers will be bidding on fewer or lesser supply. As I've explained in the past, rates or yield and price have an inverse relationship. Lower supply means higher price, and inversely, lower yield. 2024 rate forecast, interest rates mid fives to low sixes. Under 6% should unlock a deluge of new buyers. The 10-year Treasury, 3% to 4.4. We're starting the year right at 4%. It's never going to be in a straight line, but I do expect to see the Treasury down to close to that 3% mark. And what's going to be the most interesting for me is there going to be a return to a more normal spread between the 10-year Treasury and mortgage-backed securities, typically, or mortgage rates. Typically we see about a 2% spread, and over the last couple of years, we've seen 3% or more spread, which, if we get some of that, we'll actually see mortgage interest rates come back even further. Turning our attention to real estate centers again around supply and demand. Supply is tight, continues to drop year over year. You can see in this chart, look at the inventory or the supply dropping while our population continues to go up. The demand side continues to be strong. Look at the blue lines. This represents households being formed. There are far more households being formed than builders putting up houses. This is the explanation for strong markets and why you are seeing price increases and lack of inventory. 2024 is going to be very similar. I don't think there's going to be any super big surprises. I expect to see much more activity. That's going to be the biggest story of the year. But I don't believe that the supply coming to the market, there's going to be enough supply coming to the market, and that's why prices will continue to stay firm. The argument about affordability, listen, I'm not arguing by any stretch of the imagination that it's more affordable to buy a house now than it is in 2021. Interest rates are up, the cost of real estate is up. That's not an argument in any form of the fashion. But we're not talking about, and it hasn't been talked about enough. Really, the media has done a terrible job at explaining this, and this is where this really comes from. We don't talk about the income part of it. That's the key. So let's use an example. If you have a $1,000 payment with a $240,000 purchase, your income needed to be $4,000 a month. Now, we know rates have gone up. But so is the price of real estate. So you have a higher mortgage and you're having higher interest rate. And, this is what most people are looking at. If you have a 6.625 with a higher mortgage, you have a higher payment of $800 a month. You can see the difference right here. In 2021, it was about $1,000 for essentially that same house. You're paying $800 more a month. $800 a month is an 80% increase. Look, this is super significant. I'm not denying that. But my argument is you do not need an 80% increase in your income to offset an $800 increase in payment. What do you need? You need a 20% increase in your income. And if you look here, ADP tells us that incomes have risen 15% since 2021. Now, listen, this is a simple way to look at this, and there's plenty of nuances, but the majority of this tells us by the end of 2024, with income going up another 5% and rates coming down, we should be in a position to alleviate the affordability issue, or at least be very, very close to eliminating it altogether. 2024 real estate forecast. We all know real estate is very, very local, but nationwide appreciation should be anywhere from 4 to 5%. But the best news, and really the story of 2024, is going to be the increase in transactions. It's not going to have that sort of gridlock feeling that we've had in 2023 where just nothing is moving or not much is moving. So I expect transaction volume to really be up to 20% on a nationwide basis. Obviously, again, real estate's local. So depending upon where you're at locally, you could see a little bit higher, could see a little bit lower. But the bottom line is, if you've been able to make it and you're in the industry, you have a good year ahead. And kudos for you to surviving, making it throughout the year, into 2024. My name is Darin Hunter. I want to thank you very much for watching. I really wish everybody all the best and all the success in the world. If I can help in any form or fashion, whether you want to collaborate, whether you have any questions, whether you have any concerns, whether you think I'm full of baloney, let me know. I'm happy to answer any sort of questions. My name's Darin Hunter. I wish you all the best. Have a great year.